Everybody, it is John King. Welcome to my Financial Fridays live broadcast. I will be coming to you every single Friday with a live broadcast at 12 noon Pacific time. And the broadcast is going to be on topics that impact you as a homeowner. So, what are your things that you need to know, either as a current homeowner or a future homeowner, how to become a homeowner, how to be successful in home ownership? So, join me on this wild ride. I look forward to giving you value, helping you to know what all of your options are as a homeowner. So we're going to spend an hour together every single Friday at 12 noon. If you want to join future webinars, please sign up on my email list. So I will be sending out emails every week on the upcoming webinars. Go to rsvpwithjohn.com. And you can get onto that email list. So you want to see any future webinars, please go to rsvpwithjohn.com and you can sign up to be notified each week. Also, feel free to subscribe on my YouTube channel and you're notified there as well. So today, I am focusing on first-time homebuyer tips. And my goal really is to spend an hour talking to home buyers, educating realtors on things that their home buyers need to know. So this is a great opportunity for interaction. So thank you. I know I have a couple people joining live right now. If you are watching live, please post your questions about anything you want me to cover about being a first-time homebuyer. Questions, concerns, fears. I'm going to cover a lot of these things, but if you're watching live, I'll be able to bring it up on the screen, bring your comment up on screen and address it. If you're not watching live, no big deal. Post your comment anyway on whatever platform you're watching this on, YouTube, Facebook, what the heck else is it on? Twitter and LinkedIn. So post your comments on there. Would love to be able to hear from you. And for those of you who are watching right now, just give me a shout out and say hi, John, so that I know who is here. Shoot me a comment right now. I would appreciate that. If you're watching after the fact, shoot me a comment anyway, so I know who watched it. And I would love to get interaction. As you see something that I bring that's a wow, if you see something that I bring that says I was worried about that too, or something that I know that I'm resonating with what your concerns are, what your questions are, I'd love to hear that as well. All right, so let's go ahead and dive in. I've got a lot that I want to cover. So the first thing that I'm going to do, a little bit of technical difficulty. All right, let's try this one last time. Perfect. All right, here we go. So the first thing that I want to do is really be able to talk you through all the steps necessary, and I'm going to cover it pretty comprehensive. So I'm gonna weave in tips and ideas and tricks that you need to know, but it's really going to be an A to Z of what you need to think about when you are a first-time home buyer, and I want to help guide you through this process. So let's go ahead and get started with how to buy your first home in 2022. First of all, let's talk about who is Summit Funding. I don't know that I spend enough time talking about the company I am with, and I'm going to talk a couple of times today because it really is the biggest tip in today's market is the lender you work with matters more now than it ever has before. And the reason for that is because it's a hyper competitive market. We have way more buyers competing for fewer homes, and the lender you work with makes a huge difference. Matter of fact, I just recorded a webinar. You can find it on my YouTube channel that I talked about tips to get your offer accepted. And it's about a 30-minute broadcast I did yesterday. Feel free to search for that. I'll also put the link down below to that. And you'll get tips to get your offer accepted. Is really, really important as you are a first-time home buyer. You're going to be competing with cash buyers. You're going to be competing with buyers that are putting huge down payments, and the average first-time home buyer doesn't have a huge down payment. So I want to start with who is Summit Funding and what makes us different. Summit Funding is in the top 30 of mortgage lenders in the country, and we are a direct lender. Now, as a first-time home buyer, you're like, John, every lender is a direct lender, aren't they? No, that's not true. You actually have direct lenders, and then you have brokers, and then you have what's called a correspondent lender. And as a direct lender, there's no middleman. I am your loan officer, but I'm not sending this to an outside company. So I control the entire process. And that is super, super important to you. It's important for communication and it's important for efficiency because we're going to get the process pushed through faster because we are the ones that are going to ultimately fund your loan. Unlike if you're in a situation where you're working with a broker, where that broker does not work for the company that's funding your loan. They have a relationship with them. It might even be a good relationship. The problem is that they, not being an employee of that company, It's just a vendor relationship. I have a much stronger ability to make things happen because I am employed by the company that's funding your loan. And personally, I'm in the top 15 of all loan officers at Summit Funding across the country. Why does that matter to you? Because it means that I've got the experience, but I've also got the pull with the company to get things done. But let me be real specific about the three things that make us different. Communication. It's things as simple as the webinars that I'm doing. We're going to communicate with you and keep you updated throughout the process. Most lenders just look at you as, hey, I'm just going to update you when necessary, and reactively when you have questions, I'll be here. But I think great communication starts with being proactive and giving you the information you need before you know you need it. The second thing is we think we deliver the finest client care in the lending industry. Now, the truth is it's a pretty low bar. The mortgage industry, I'll show you a slide in a couple of minutes. The mortgage industry is not well known for delivering great client care. And so we believe we give the finest care, and I'll explain that in a moment. And the third one is timely closings. Now you might say, John, why does that matter? Like, why do I need to pick a lender that closes on time? Well, the key is the lender has nothing to do with the contract and the timeline you wrote on the contract, but you've set up, you've given notice to your current landlord. You have scheduled a moving truck. You've got your buddies and pizza and beer waiting for them to help move you. By the way, that is the cheapest way to move. You pay for pizza and beer and get a bunch of friends over there. But that only works you're in your 20s and maybe early 30s. Once you hit your 40s, no one of your friends are going to come over for pizza and beer and move. So you might want to look at doing using a moving company at that point. I'm just kidding there. But timely closings is important because when we set a date, Summit Funding is focused from the top of the company to the bottom of making sure that we are going to deliver for you what you need in the time that you need it so that you can close when you expect to close. I want to talk for a quick second about we do business on a two-way street. And what that really means is we have expectations of you and you have expectations of us. And that comes in two forms. The first form that it comes in is communication and delivery of timely information. I promise to communicate and deliver timely information to you as quickly as possible when necessary, but I need the same from you. When I ask you for something in the environment we're in right now, this is one of the big tips. In the environment we're in right now, we've got to move quickly. And if you are, slowly getting us paperwork and you're saying, oh man, John needs an updated bank statement. Well, it's April 1st, and so I'll have my next bank statement on April 7th. I'll give it to him then. You need to talk to us and communicate with us saying, hey, I know you asked for these three things, and here's why I don't think I can get this for you. It is super, super important that you provide to me the the reason why. Hey, I can't get this for you, John, and here's why I can't get it for you. And my team and I can give you very specific feedback, saying, hey, you don't need to give us that document. You can give us something different as a different version. The second part of the two-way street is I'm going to deliver great service and take great care of you and keep focused on you instead of focused on going and finding my next client. But that focus on you to deliver you amazing service means that I'm not chasing my next client as much as some of my competitors are. So I'm counting on you to help me find my next client. Simplest thing you can do is share this information. So subscribe to my Facebook or subscribe to my YouTube channel, share my videos out on social media with your friends and people that you connect with, because that helps me get the word out. I want to be an educator and helping to educate my clients and everybody that my client knows. So if you can help me get the word out there and help me continue to show awareness of the value that I provide, that lets me focus more on providing that value instead of focusing on chasing the next loan. All right, let's talk about, is this a good time to buy my first home? That is the number one question I'm getting right now. People are super fearful, super fearful. John, what's going on in this market? We're dealing with some pretty major events right now. We basically are dealing with an oil crisis like we had in the 1970s. We're dealing with inflation like we had in the 1980s. We're dealing with a stock market correction like we had in the late 90s and a housing affordability issue like we had in the early 2000s. And I want to talk for a quick second about housing affordability. That is something that is a global term. It's a news media worthy term that splashes on the headline saying housing affordability plummets. Well, that's more of a statistical number. And that says that the average person can afford to buy, based on the average income, this much home. And as prices go up, as interest rates go up, therefore payments go up. And unless the average person's wages are going up significantly, fewer people can afford a home. That's a fact of life. But what you have to really think about is not the macro economy of the world or of the country. You need to think about the micro economy of me. What is your income position? What is the stability and the expectation of stability in your future? Do you have a job that you feel confident and stable that you're going to continue to receive good income going forward? If you do, then you're in a great position to buy a home. If you've just opened up your own business and you don't know what your income's going to look like, how stable it's going to be, or you're in a position where you're in an industry that is in a downturn and that industry is losing, um, how should I say, that industry is losing uh, jobs and is pulling back. I would be concerned about whether it's a good time because there is a major concern with whether or not we are dealing with. Oop, I just went to the next slide. I didn't mean to. Um, we have a major concern of dealing with whether or not you're going to be able to continue to maintain your job. And that's super, super important. If you're in that position where you have any doubt or question, you have to decide, hey, I've got to feel confident in making this payment. But let's be super clear. If you don't own, you rent. And a lot of people are concerned right now about the skyrocketing interest rates. Guys, let's put a little perspective behind the term skyrocketing. Rates are high 4% range. That's not skyrocketing. Rates for a long time had been significantly higher. Yes, they've come down, but wages have gone up. The average person can afford a significantly higher payment, but let's just go down to the most simplest fact. You have to rent, and rents are going up as well. And if you don't buy, you're going to be subject to continued rent increases going forward. And it is my biggest fear for first time home buyers to say, now is not a good time to buy. I'm going to buy later when prices are lower because a crash is coming. Guys, I don't think a crash is coming. I think that there will always be ups and downs. There will always be corrections, but I don't see a huge correction coming to the housing market. What I see is I see people worried that 2007 is going to happen again. 2007 to 2011 happened because the mortgage industry was doing loans we shouldn't have done. The mortgage industry was giving everybody an adjustable rate mortgage and was saying, hey, don't worry, we will refinance your mortgage in a year or in 2 years or in 3 years when rates are lower and values are higher. And it is not a guaranteed circumstance, but it created a domino effect when that guarantee went away. Because when one person lost their home, the next person couldn't refinance. And because that person was on an adjustable rate mortgage and they couldn't refinance, their payment was going up and they couldn't keep their home. That domino effect is what caused the markets to crash in 2007 and 2008. But it is not because housing prices have gone up. Historically, housing prices continue to go up. Housing has been one of the best investments that you could put your money into at all. And over any 10-year period in the history of the last 50 years, I've been tracking this, housing prices have consistently gone up. Oh, even when we had a huge drop from 2007 to 2011, they rebounded and back to where they were in 2017. So if you're not looking for a quick flip, if you're not looking to earn a buck off of buying a home and reselling it a year or two later, making a huge amount of money, which was great in the last couple of years. Prices have gone up significantly, but typically house prices go up 3 to 6% per year, and that's amazing when compounded over time. So I am not a fan of the statement, is it a good time to buy? In other words, timing the market is a flawed strategy. The strategy you should be thinking about is time in the market. How much time am I spending as a homeowner? Even if housing prices never went up, you're going to make the same monthly payment for the next 30 years and your balance becomes zero. Where if you're a renter, you're basically paying 100% interest. All of your payment is going to the landlord's pocket. No money is being paid down on principal. You're getting no tax deductibility. And so the only thing that I want you to really take away from this section about is this a good time to buy my first home is personally, How do I feel about my monthly payment budget? How do I feel about my ability to afford this payment compared with rent? And yes, you are likely to spend more on your monthly payment for a house than what you're spending in rent. But compared to what rent's going to go up to in 10 years, you'll be happy you locked in a low mortgage payment now. So that is super, super important to understand as I'm talking to people about time of the market and whether it's a good time to buy your first home. If you plan on staying in the house for at least 5 to 7 years, if you think your income is going to be stable and you can afford the monthly payment, it is always a good time to buy a home. So here's the deal. Getting a mortgage today is tougher than it has absolutely ever been. The economy is in flux. We're dealing with war. We're dealing with inflation. Guidelines are changing. And so it's super, super important that you get started on the right foot by having a conversation with me early. There is nothing bad that comes from talking to me early on in the process. If you think I'm going to buy a home in 2023, John, there's no point in me talking to you now. I don't want you pulling my credit. Ladies and gentlemen, your credit is very, very minorly impacted when we pull your credit reports. I like to use the analogy of when you go to the doctor and you do an x-ray. Is doing an x-ray harmful to you? Yeah, you're subjecting your body to radiation. But is it really that harmful to you if you did one x-ray every year? No. It's harmful to the x-ray technician that if they didn't wear the protective gear and if they didn't stand outside the room, they're going to be subject to radiation multiple times a day, every single day. And that is where it becomes a major problem. But your doctor, in order to diagnose you properly, needs to take an x-ray. Your doctor needs to draw blood. I hate having my blood drawn, but it is a necessary step. I need to pull your credit and take a look at it. And here's my next big, big tip. There are things you don't know that can stand in your way to home ownership. And if we open the kimono, if we look at everything as early as possible, then we're going to identify those issues even if you didn't think it was a problem. We're going to talk in a few minutes about the three major things that we look at. I'll put my hand over here. The three major things that we look at when qualifying you to purchase a home, and that's going to be cash, credit, and income. And all too often people say, "Oh, my credit's fine and my income's fine and I just have questions about cash and down payment." I'd be doing you a disservice and you would be doing yourself a disservice if you didn't let me look at all three things because we may uncover something you did not expect and we would regret not looking at what these things are, not looking and dealing with this now. I have a story about a client that I helped buy a home when I first started talking with her, she was self-employed and she said, "Hey, John, I've been referred to you, strongly recommended that you're the guy to work with, and I've been working with another guy, building my credit, and he's helped me out, and I'm now at the point, I talked to him a couple of years ago, and he told me what to do, and I'm pretty sure I'm there, but I'd rather use you. So can we sit down?" Great, we sat down, and I sat down across the desk from her. We pulled up her credit. That's all she wanted to talk about, and I said, "Great, let's take a look at your taxes." She says, "Oh, I didn't bring those taxes." And I said, "Okay, well, we need to make sure that we've got a look at your taxes. Let's set up another meeting." She comes back the next day. I'm taking a look at her tax returns. And I said, "Hey, help me understand here on your taxes. You had said that you make $100,000 a year, but that's not what I'm seeing on your tax return." And she says, "Well, yeah, right there at the top. I'm self-employed and I brought in $100,000 of income." I said, "Yeah, but you're showing a lot of expenses. You're showing a lot of cost for running your business, and it says you only had about $20,000 left over after those expenses." And she says, "Well, John, that's normal. Like that's because I have a good accountant, and my accountant helps me to make my taxes look better, so I don't pay as much in taxes to the IRS. But truly, I made $100,000." And I had to break it to her that that's not how we look at it. We look at it as your total after taxes. And she was devastated. She literally broke down crying and she said, "John, I've spent the last 4 years working on my credit because the lender I was talking to, we talked in general in the beginning and I told him I made 100,000 a year. And he said, great." Then we talked about my down payment money. He said, great. We talked about my credit and he said, not so great. And he never asked me to look at my taxes. And that's the flaw. You think everything is okay And then you end up, she's worked on the one problem, not knowing there was another problem that was there. So talk to me early on about the process so that we can make sure that we give you the best possible advice and make sure we leave no stone unturned. So I want to really point out here. I talked earlier about it's a super low bar that the mortgage industry has set. The mortgage industry stinks. Right there at the top, you see Fannie Mae had a survey that 68% of borrowers were dissatisfied with the mortgage experience. And I want to point out that something that most lenders focus on is giving you a great loan. And that's their goal. Like, I'm going to give you a great loan, but that's only part of it. I want to make it an amazing process. I want to give you great client care. And that starts with the education that I'm giving to you right now. And it's my job to make you an advocate of my business, a raving fan of my business. And that's by providing you the information you need when you need it before you even realized you needed that information. So that's really my goal as we go through this process and over the next 40 minutes. By the way, if you have any questions, please post them. If I know there's 3 people watching live right now. So if you just want to say hi and post me a hi, John, on comments, I would appreciate it, just so I know I'm not talking to myself. And if you're not watching live, just post anyway. Give me a thumbs up or a hello just to let me know that you're there. I would really, really appreciate that. Guys, here's the next thing about buying a home that I need you to understand. I need you to understand that this is a broken industry. I've already talked about the regulation, I've already talked about all the challenges, but I need you to set your expectations properly. I need you to think about this process like you think about the process of getting on an airplane and flying across the country. I'm sure every single one of you have done that and you've gotten on a plane and you've flown across the country. And the truth is, when you get on that plane, you have no idea whether you're going to hit turbulence or not. It is the pilot's job to chart a course to make sure that they get you to your destination on time, safely, with the minimum amount of turbulence. If the pilot has the ability to fly around the turbulence, fly at a higher altitude or a lower altitude, or go a little bit around it one way or the other, they absolutely will. But the truth is, a good pilot also knows I need to get you to your destination before we run out of gas, and I need to get you to the destination without being much later than what we promised you. And sometimes the easiest path is straight through the turbulence, but it's not a sign of a bad pilot. The sign of a good pilot is a pilot that tells you ahead of time so that you're not drinking hot coffee at the moment that you hit significant turbulence. That's a good pilot. The mortgage process is the same. So the next tip that I've got for you is set your expectations correctly. A great process is not one that doesn't have challenges, because we're going to run into challenges in this process. And it's my job to foresee those challenges, but sometimes we just got to fly right through them. Sometimes I can find a way to go around them. I can divert them. I can bob. I can weave. I can get out of the way and make sure that we don't have those issues. But there's a lot of times when that isn't an option, and just recognize that we have to figure out a way to get through this, and that sometimes there are issues that are going to come up that we could not have foreseen. And I need you to be prepared to help along with me to fly right through that turbulence, and we will take great care of you to make sure we didn't just serve you hot coffee. So let's spend a couple minutes really talking about the process. Step one is getting pre-qualified, pre-approved. Those words are a bit interchangeable, but they're actually not. And hold on a second, I just noticed I got a couple of comments. Hey, we got a couple of people. So Kathy, hi Kathy, Erica, thank you so much. Looking forward to partnering with you as well. Appreciate that. So guys, continue to post your comments. I appreciate that. Here's what we're talking about. The the process of buying a home starts with getting a meeting with me to get pre-approved. That pre-approval may mean that I'm just looking at your paperwork myself and giving you my stamp of approval that we're good. It might mean that we're submitting your file to underwriting, which is really step 4. But in today's market, it's one of the things we're doing to make your offer stronger. And if you watch my video from yesterday, I've got a 30-minute video I referenced earlier where I talk about tips to get your offer accepted. And a week ago, I did another video that I talked about how to close an escrow in 14 days. So go to my YouTube channel, youtube.com/John Lone King. You can find all of those videos in my library. Really, really good information in today's market to help you be successful. So step four of underwriting sometimes will happen sooner in the process. But the truth is, the normal process goes you get pre approved and then you go find your home. Now, this is the area that is full of tips that I need to give you to be successful in the home buying process. The first thing that I will tell you is don't go it alone. A lot of my clients ask me, hey, John, do I really need to have a realtor or can I save money without a realtor? A realtor is paid for by the seller of the home. So if you are buying now, unless you're buying a home that's a for sale by owner, which has a whole other set of challenges because now you have no legal representation. Buying a for sale by owner where neither one of you have a real estate agent is fraught with challenges. It's very much like going to court to defend yourself. Legally, you can do it. It's a horrible idea, and you do not want to be making the single largest financial decisions in your life without an expert by your side. So if you have a realtor you're going to use, stick with that realtor. If you don't have a realtor, call me. I will connect you with an amazing realtor. I have phenomenal realtors. Some of them are watching this video right now, and they will be able to take great care of you, and I will connect you with a great realtor. But the first tip, don't go it alone. You're going to pay anyway. The second tip, a lot of people say, okay, John, I understand that. So I'm going to go ahead and call the listing agent. I'm going to have the listing agent represent me in this transaction because then I'm more likely to get my offer accepted. I will say, buyer beware. Sometimes that works, but you're basically putting your best interest in the person's hands who also has an obligation to the party you're negotiating with. And try serving two masters at once. That's really what you're asking that realtor to do. If it's a great realtor, they can do it, but it's challenging. And if you happen to be in a situation where you know the realtor and you were connected to them, some realtors can do this very, very well. But what I'll tell you is when you just pick up the phone and you call the realtor whose name is on the sign, you end up hiring that person without knowing their pedigree, without knowing their experience, and without knowing where their loyalties lie. That's a very scary proposition. Here's the next tip when you're talking about finding your home. You've already listened to everything I've said so far. You decide, okay, John, I'm sticking with one real estate agent, but it's Sunday afternoon at 5 o'clock and this house just came on the market and I don't want to bother my realtor. So I'm going to go ahead and pick up the phone and call the listing agent because it's their job to show me this house. And then I'm going to let them show me the house. And then I'm going to go back to my realtor and have my realtor write the offer. There is a legal term called procuring cause. Procuring cause means that the person who essentially was the first one to show you the home is the reason you are buying that home, and they automatically become your representative. Let me say that again. In California, the person who shows you the home, and now open houses don't count because that's designed as a hey, anybody can come in and you're not hiring that realtor. But if you call the listing agent and have them open the home for you, then that listing agent is essentially the procuring cause, and you have hired them to represent you unwillingly, even unknowingly. And that is a major challenge for a lot of buyers that they just don't understand that they've stepped into. The same holds true for new construction. If you're thinking of buying a brand new home and you are looking at new homes, some new home uh, uh, sellers, some new home builders will allow you to have your own representation. Some will not. Let me say that in a different way. All of them will allow you, but I told you earlier, the seller pays for your realtor. Well, some of the new home builders feel like, hey, I don't really need real estate agents. So therefore, I don't need to pay them to represent the buyer's best interest. We have our agent that can represent both sides. So if you bring a realtor into a transaction where the seller, the builder, will not cooperate, will not pay that realtor, then you either are going without representation or you're paying them. I think we'd all agree that you wouldn't be expected to do your job without getting paid, and that you shouldn't expect your realtor to do their job without getting paid. So make sure that you're bringing your realtor with you to every new home community you go to before you ever visit. because the real estate, the builders who cooperate, who will pay for your realtor, typically will only do so if your realtor was the procuring cause. Your realtor was the person who brought you to the community. So it's super, super important that you make sure that the realtor that you want to represent you takes you to the property, and that way they register you. You can visit later without them, but they have to register you on the first visit. So I covered a lot about finding your home. Those are a few things that I want to make sure that you cover. I've got a lot of tips on my recent video about how to get your offer accepted that I think are super, super important. Just recognize this right now, April of 2022, very imbalanced markets. It is a seller's market, which means there are fewer sellers with more buyers. So the sellers are in control. They have the upper hand, and it is causing prices to go up quickly. And so you need to be ready to move quickly and make quick decisions. You need to be willing to pay over the asking price. You need to be willing to do a offer with minimal or no contingencies. And those are things that we can go over. My video yesterday about how to get your offer accepted covers this in more detail, but we can cover that also during our one-on-one consultation. Let's move on to step 3, processing. Once you get your offer accepted, congratulations! That is the hardest part in today's market. At that moment, that's when we freeze your interest rate. And I'm going to talk more about interest rates in the second half of this webinar, but that's the moment we freeze your interest rate, and then we start all over again, verifying everything you showed us from the beginning. So you're going to have to prove your pay. You're going to have to prove your bank statements. We may have to repull your credit. We start all over with processing your loan because even though I pre-approved you, even if we fully underwrote your approval, there's age of documentation requirements. We have to make sure that we're approving you again based upon the most current information to confirm nothing has changed. So that is super, super critical that you understand that we have to move quickly. And at that moment when we're in processing, we're going to ask you for something. We need it back same day, next morning, worst case scenario. Then the file goes back to the underwriter. They're the one with the authority. They're the ones that make the final decision. Now, I'm really, really good at what I do. I have been in the top 1% of mortgage originators for the last 7 years straight. I'm in the top 15 in Summit Funding, who's a top 30 mortgage lender in the country. But they have yet to give me the authority to make the final decision. I'm hoping to get it. No, I'm not, because that would make me an underwriter, and then I don't have the ability to help you up front. They need somebody whose job is specifically licensed to confirm that you meet all of the rules, and someone that doesn't have a relationship with the buyer. So there's always separation between you as the buyer and the underwriter. You're never going to talk to the underwriter because they have to make a a technical decision, not an emotional one. Logical decision, not an emotional one. I understand your story and I'm going to try and convey that to the underwriter. They have to look at it based on the rules and say, well, here's what I know. Here's what the rules are. Does it meet the rules or does it not? So there's always going to be a gap between you and the underwriter. During that process, we're also going to appraise your home, the new home that you're looking to purchase. That's a challenge in today's market. It's a challenge to get an appraisal done quickly, and it's a major concern for sellers that the house is not going to appraise for what you offered on it. So when we do our consultation, I'll talk to you about appraisal gaps and how we can cover those gaps based upon the amount of your down payments. But that's a super critical part of this process. The fifth step is your signing of your paperwork. So that's really the exciting part where we're ready to close your loan. You've been final approved. And then we get you meeting with a notary. You sign your paperwork and then you get your keys. And step number 6 is you move into your home. Hopefully, you do a better job of stacking your boxes on the hand cart than what we see there in the image for step number 6, because I think those boxes at the top hopefully aren't marked fragile because it looks like they're about to fall off. All right, so let's move on to types of loans. I'm going to camp out here for a few minutes. This is really, really important for you to understand as a first-time home buyer. First of all, there are 3 major types of loans. You've got conventional loans, you've got government-backed loans, and then you have jumbo loans. Your conventional loans, you've probably heard the names Fannie Mae and Freddie Mac. I kind of talk about them like they're the Coke and Pepsi of the mortgage world. There's pretty much no difference between Fannie Mae and Freddie Mac to you. To me, it's the recipe they use that has a little bit different guidelines. There's things like how we treat student loans. If you have student loans, Fannie Mae looks at it one way and Freddie Mac looks at it another. How we treat somebody's self-employment income, Fannie Mae looks at it one way, Freddie Mac looks at it the other. But we combine both of those together when we talk about conventional loans. A conventional loan is up to the annual limits, which currently is 647,200. That's the loan amount. So some counties have higher loan limits for conventional loans if they're in a high cost county. The Bay Area can go up to 900 and some odd $1,000 as a conventional loan. So just recognize you have the national limits, but then in high cost counties, you can go higher than that and still be a conventional loan. A conventional loan, this is where we talk about the three things that we care about in a loan, which is cash, credits, and income. So cash is the amount of money you have for down payments and closing costs. I'll talk about closing costs in a couple of minutes. Credit, I've got here two things, ideal credit and minimum credit. Because even if you hit the minimum, there's major problems. You're either going to pay significantly more in interest rate and monthly payment, and your loan is going to be significantly more scrutinized if you don't fit the ideal. So just understand, as an example with conventional loans, it's ideal to have at least a 740 or better, but the minimum credit score for conventional is 620. But in the case of conventional, it is super sensitive to the combination of your down payments and your credit score. So if you're only putting 10% down and you have a 620 credit score, if you get approved, you're going to have a significantly higher interest rate and a significantly higher monthly payment than if you had gone with an FHA loan, because FHA is much more forgiving. So I'm going to talk through this chart for a few minutes, but here's the most important thing I want you to take away from this chart. I am an expert and I will guide you. It's very much like, when you are looking at anything that you do. If you're looking, hey, I've got a legal issue and I want to hire an attorney. The attorney has lots of tactics, lots of techniques, lots of strategies they can use. You're hiring the attorney to listen to your situation and to guide you, to give you strategic advice. A better example might be a financial planner. You hire a financial planner to tell you where you should put your money, listening to what your needs are, listening to how you want to grow your money and when you need access to it, and then telling you this is what you should do. That is my job. My job is to tell you what type of loan you should get. It is not your job to figure it out. Self-serve can be done, but self-serve is kind of dangerous because there's things you don't know and there's assumptions you're going to make. And so I strongly recommend that you let me guide you. And if you have questions, if you say, John, well, my buddy got this particular loan over here, how come you didn't offer me that? Either A, I don't offer it. That's almost never the case. There's very, very few loan programs I don't offer. Or B, I've evaluated it and I've decided that it was not a good fit for you. Every once in a while, I'll look at it and say, yeah, I guess we could go that direction, but I think this is still better. And you might have a toss up to go that direction. Feel free to ask questions, but just understand I'm going to help you navigate these waters. So a conventional loan, by the way, we talked about cash in general, talked about credit. Income, income is a pass-fail situation. Credit is a sliding scale. So with credit, it is, hey, every little bit better or worse your credit is, a little bit better or worse you're going to be having an interest rate. But income is not a sliding scale. You either have enough dollars coming in to make your monthly payments or you don't. And so income is simple. If you don't make enough money to make the payment, you won't qualify. And we either need to lower your purchase price or increase your down payment in order to get your debt to income ratio in line. So now let's talk about conventional loans. 10% down or more is ideal. You can do less than 10% down. As a matter of fact, you can do as little as 3% down, but you're going to pay a lot more as you get smaller down payments. And so conventional is ideal if you're putting 10% down or more. It's ideal if you have a 740 or better credit score, but you do have the minimum credit score of 620 that if you're putting a huge down payment, conventional may still be a great choice. Income-wise, a conventional loan does not want us to spend typically, ideally, around a third of your income. So the 28 and 36% has to do with what percentage of your pre-tax dollars we're spending on your house payment and what percentage of your pre-tax dollars you're spending on your total debts. And the only reason I'm showing you this is to say that conventional loans are typically more restrictive on your debt to income ratio than a government backed loan like FHA, VA, or USDA. Your government backed loans have annual limits as well, but they vary. Sometimes they're as high as conventional and sometimes they're not. The nice thing about government backed loans is that they're much more forgiving in your down payment. You can do 0 to 3.5% down, much more forgiving on your credit score. Ideally, a credit score for a government backed loan is 640 or better, and you can sometimes go as low as 580. And ideally, they're around 33 and 45% of your income. In other words, they'll let you spend more of your income than what a conventional loan would let you spend. I'm going to pause here for a quick second, guys, and make it super clear to you. The the number one debt to income number that matters is not my statistic, it's your comfort level. If you are not comfortable with the monthly payment above a certain number, do not let me or anybody else convince you of it. I'm not going to convince you of it. I'm going to ask you in the beginning, what is your target purchase price? What is your target cash out of pocket? And what's your target monthly payments? Then I'm going to go back to the questions again. What's the lowest purchase price you would consider? What's the highest monthly payment down payment you would consider? And what's the highest monthly payment you would consider? Now, I don't want you going to the highest or even above the highest, but we've got to make all three of those things fit together because it's the purchase price, your down payments, and your monthly payment that those three things play off of each other. If the payment is too high, you need to lower the purchase price or you need to increase your down payments. If the down payment number is too high, then you need to lower your purchase price or you need to increase your willingness to pay over a certain monthly payments. And if your purchase price that I tell you you're qualified for is too low, then you either need to be willing to spend more money per month or you need to put more money down. Okay. The bigger the down payment, the lower your monthly payment. And I can get you any payment you want. If you put 100% down, you have zero monthly payment. Think about that for a second. It means you didn't have any kind of a mortgage. But the truth is, you can have a large down payment and lower your monthly payment. So we can come up with the numbers whatever you want. We just have to make sure that the math works. So I hope that makes more sense. Let's go ahead and dive in a little bit further into this, and then I'll go on to other things I want to discuss in the next 17 minutes before we wrap up. Much more forgiving on FHA, VA, and USDA. A jumbo loan is a loan that you're going over the conventional limits on your loan amount. Now, you could buy $1 million home and get a conventional loan as long as you're putting $355,000 down, because now you're borrowing $645,000 and it's within conventional limits. A jumbo loan ideally wants 20% down or better. There's some programs where we can go 15% down or even 10% down, but ideally you want 20% down or better. A 740 credit score is ideal, but you really need around a 700, sometimes as low as 680, but super hard. Jumbo loans are significantly harder to get, and jumbo loans require a high amount of reserves. Reserves is not something that I've talked about so far, and reserves is super important. I'm going to cover that in a little bit, but as a requirement for qualification, conventional and government loans do not require reserves. Jumbo loans do. Okay, let's talk about actual cash needed to close. This is a huge tip because it's a huge source of misunderstanding from first-time home buyers. People say, oh, I'm going to do a VA loan. I don't need any down payment. That's true, but you still need closing costs. I'm going to do an FHA loan. I only need 3.5% down payment. That's true, but you still need closing costs. And people forget that. So I'm going to cover with you. First of all, the average amount of closing costs is about $10,000. And realistically, it could be as low as 7 or 8,000 to as high as 15,000 on average. 10,000 is a nice placeholder that I use. So if you're thinking, hey, I'm going to put 3% down on a $400,000 home, I need $12,000. Yeah, you need closer to 22,000 plus or minus. I might even be thinking in my mind, maybe 25,000. You've got to be adding at least $10,000 to your down payment percentage in order to come up with the total cash needed out of pocket. So where can that money come from? There's three places a down payment can come from. It can come from your own money, it can come from gift funds, or it can come from a down payment assistance program. One of my upcoming Financial Fridays, probably in May, I'm going to dive into down payment assistance programs, and I'm going to spend an hour covering those in detail. I have a down payment assistance webinar on my YouTube channel that I had created back in, I think, 2020 or 2021, that spends another hour going into down payment assistance. It's 2 years old. It's about 80% accurate. So in the meantime, until I do my Financial Friday update on down payment assistance, you can feel free to go back to that one. Very comprehensive. Most of the information is still very, very accurate, and the concepts are still in play. And here's the deal. There's no such thing as free money. Down payment assistance comes at a cost. You're going to pay a higher interest rate typically on the mortgage. You're going to pay higher closing costs on the mortgage. You're kicking the can down the road. Even on grants, where you're going to get a grant for your down payment, and you think, John, I'm not kicking the can. I don't have to ever pay back the assistance money. Some assistance is a grant, some assistance is a loan. Sometimes the loan has interest, sometimes it doesn't. But the key is you're always paying more than you would have paid if you came up with the down payment and closing costs yourself. So if you have the ability to come up with the down payment and closing costs, I do not want you to skip that simply saying, oh, cool, no big deal, because I can use down payment assistance, I might as well. It may be a good idea because you keep money in reserves. But if you can get money from somewhere else, gift funds, what I like to call bank of mom and dad, is a great place to go get funds from. So just be aware of that fact that down payment assistance can cover your down payment, some of your closing costs, but even with down payment assistance, you're going to have some closing costs you still need to pay out of pocket. I'll cover that more in depth when I do my next one, probably in May, because I've already figured out what all my April ones are, and I'm not including this in April. But I will make sure that we do a down payment assistance webinar in May. Um, Closing costs cannot be paid for. I'm sorry, can be paid for by the top three, by your own funds, by gift funds, or by down payment assistance. But there's two extra areas closing costs can be paid for. They can be paid for by a seller credits, and they can be paid for by a lender credits. The problem is in today's market, there's a couple of reasons why those two methods are not used very often. First of all, a seller credit. Homes are in high demand. Why would a seller sell a home to you and pay $10,000 of your closing costs when they could sell it to somebody else and pay none of their closing costs? So sellers have no real incentive to pay closing costs for you. When it's a more balanced market and a seller wants a quick close and you're like, hey, I'll give you everything you want, but you give me your closing costs, that's great. That's a perfect scenario. And sometimes in today's market, you can find a more desperate seller, especially if a house fell off the market and just came back on, or it's been stale and sitting on the market for a couple of weeks. Then you can negotiate, especially if the seller was about to lower their price. Now, we never know when the seller's about to lower their price, but we can have some pretty logical expectations around it. If somebody put a house on the market for $450,000, 3 weeks ago, there's a really good chance if they're not in contract yet that they're likely to lower their price soon. Well, instead of waiting until they lower their price, go in and offer them $450,000 and ask for a $10,000 credit towards closing costs. They were probably already planning on lowering the price to 440 or even 430, and you have the ability to swoop in before that price is dropped. This is where having a great realtor on your side matters, because if you're just picking up the phone and calling the listing agent, you're going to miss those opportunities. By the way, I forgot to say something about realtors and which using one realtor. The final piece I always want to really stress to first-time home buyers: use only one realtor. First-time home buyers often misunderstand and say, you know what, I'll just have three realtors searching for me because that way I have 3 times the likelihood of success. You actually have 1/3 of the likelihood of success. Here's why. Because when you go to a home and you have specific criteria, you need a certain size backyard and a certain size kitchen, and you go to a house with one agent that has the perfect backyard, you're not going to say anything really about it because it's perfect, but you're going to complain about the size of the kitchen because it's not the layout, not the design that you need. Now, if you were using that same realtor and you go to house number two has the perfect kitchen, but the backyard is too small. Now, if that same realtor is representing you at that second house, the realtor knows, okay, so the kitchen and the backyard are super important. But if you took two different realtors to each of those open houses, they only know half of what your needs are. They're going to continue taking you to the wrong home because they don't have all the right information. And that is critical that you work with one realtor. If there's a problem with your realtor, let them know. And if you can't resolve it, change realtors. But don't just play multiple realtors at the same time thinking you're going to get a better deal. You're not. All right, I got 10 minutes left. I still got a lot to cover. Hopefully, I've been very beneficial in going deep into this stuff. That's really my purpose. Interest rates. Biggest topic today is interest rates. Everybody's asking me, John, what about interest rates? They're going up. I think they're going to keep going up. Subscribe to my YouTube channel. I provide a lot of content about what's happening with interest rates and why and where I think that they're going. So as you can see on the banner on the bottom, follow me, subscribe to my YouTube channel, youtube.com/John Loan King. Interest rate determines monthly payments. So people are worried, John, I don't want to buy now because rates have gone up. But here's the truth. People have been buying for the last 2 years when house prices have been going up significantly. And when the house price goes up, it not only means you have to pay a higher monthly payment, it means you have to pay a higher down payment. So the reality is rents are going up too. And if you sit back, inflation is a major problem right now. And that's what I say in the second box. Inflation is driving this run up. As soon as we get inflation under control, we're going to see interest rates stop skyrocketing. The reality is, I think we're going to end up in a recession. Now, recession, remember I told you earlier, I need you to focus on, is this a good time to buy based upon your personal situation? A recession means some people are going to lose their job. A depression means a lot of people lose their job. There's actually a joke that says, what's the difference between a recession and a depression? A recession is when somebody else loses their job. A depression is when you lose your job. Okay, I shouldn't make fun of that, but it is a funny joke. The bottom, can I get a haha from somebody? I got a couple of people watching right now. Anyway, the reality is that inflation is driving this, but we are likely to end up in a recession because the way to stop inflation is to slow down the economy. Slowing down the economy is the definition of recession, and in recession, interest rates drop, housing prices don't. So in a recession, you will be able to refinance your loan to a lower interest rate in most circumstances. Thank you, Kathy, for the haha. Let's give Kathy a shout out. So Kathy, thank you for the haha. Appreciate that. All right. So the question everybody asks is, should I wait for interest rates to drop? Well, the problem is house prices are likely to keep going up. Matter of fact, I have a YouTube video. I'll post it down below in the comments once I'm done. And the YouTube video talks about the future of housing prices. I believe housing prices are going to continue going up for at least the next 3 years. And so you don't want to wait for rates to drop because you're going to end up paying a higher price for the home at that time. Now you can say, well, then should I wait for housing prices to drop in 2025 or 2026? A drop is going to look like this, not a crash. And you've lost time in the markets. You've lost the opportunity to get tax savings and to make the house your own and not have to worry about rent increases and all that kind of stuff. So, no, I don't think you should wait for interest rates to drop. I don't think you should wait for housing prices to drop. Okay, speaking of interest rates, guys, everybody is confused. Matter of fact, I'm going to hide. There you go. Perfect. I hid myself in there. So you have a lot of factors that go into determining an interest rate, and most people misunderstand. First time home buyers, even repeat home buyers, nobody understands how interest rates are determined. The market is part of it. The fact that interest rates are moving up and moving down in general absolutely comes into play. But your interest rate, these are 30 different factors that determine your interest rate. All of them matter because it drives what type of loan program. So don't misunderstand. Looking at number 26, that doesn't mean that if you're not a citizen, you're going to pay a higher interest rate. But it means that some loan programs are only eligible based upon a certain type of citizenship. And if you don't have that type of citizenship, you have to get a different type of loan program. And that different loan program may come with a higher interest rate. Sometimes it's as simple as, are you including taxes and insurance? Number 30. If you do not include taxes and insurance in your monthly payment, you're going to pay a higher interest rate because it's a higher risk to the bank to trust you to make your tax and insurance payment versus us paying it for you. So lots of factors that go into this that you got to make sure you pay attention to. All right, so let's move on to issues to be concerned about. As you're looking at purchasing a home, job history is super important that I pay attention to. We're looking for gaps in employment. We're paying attention to how long have you been employed, but don't overthink this. Talk to me, because sometimes we create our own roadblocks by reading stuff that doesn't apply to your situation. Your job history has a very little impact to what you're going to earn in the future unless you are paid a variable amount of pay. If your pay is fixed, if you are paid salary, or if you're paid an hourly wage and that hourly wage is a fixed amount that you get paid every week for the same number of hours that you're working, then I can predict the future. Even if you've had gaps in employment, even if you've been furloughed, I'm okay with that. The second thing to think about is mortgage insurance. People freak out. Oh my gosh, I don't want to pay mortgage insurance. Mortgage insurance isn't a big deal. It's just an additional cost to offset the risk of your down payments. So don't overthink it. If we can find a way to not pay mortgage insurance, great. I will help you to not pay mortgage insurance. And as a matter of fact, you don't always need 20% down to not pay mortgage insurance. That's another tip. If you have good credit, you can often buy a home without putting 20% down and still not have mortgage insurance. Will a cosigner help me? Um, Cosigners will only help if you have a problem with debt to income ratio. The fact is, three things we care about: cash, credit, and income. If you're short on cash, they don't have to cosign, they can just give you a gift. If your credit's not good, a cosigner is not going to help you, because a cosigner, we use the worst credit score of the person of everybody on the loan application. So if your credit score is really low, you have a better credit score loan app co-borrower. It doesn't change the fact that we're using your lower credit score. Third thing is credit score, and how important is credit? Super important. As a matter of fact, one of the webinars I'm going to be doing in April, my Financial Friday, I'm not sure which week, I think it's the third week in April. I'm going to be talking specifically about credit, how it works and how to maximize it, how to build it, what myths you need to be worried about. So sign up for my Financial Fridays by going to RSVP with John, and I will get you on the email list to update you when that comes out. Guys, I want to take the last 3 minutes and do a quick overview about wealth accumulation, because I think that's the key that people miss. Home ownership is about two things. It's about having something that is your own, and that is super, super important, and there's stability in there. But the other part is building wealth. The average American that is a homeowner has significantly more wealth than the average American that is not a homeowner. And I want to talk to you quickly about my 4-step process or plan to help you accumulate wealth. So the first step is owning your primary residence, which is exactly what we're talking about here. And I'm going to talk to you about return on investment. I'm going to go through this quickly, go back and repeat this part of the slide if you want to, but stick with me here. If you buy a $450,000 home putting 10% down, you wrote a check for $45,000, not counting closing costs. Now, average real estate goes up about 3% per year on average. No matter what, you got the big years, you got the bad years, 3% on average, but I'm going to be conservative and say it goes up 2% every year. What's going up is 2% of the $450,000. So over 5 years, you grow by 10% in that 5 years. Now, in the last 1 year, we've grown by 10%. We've grown by more than 10% in the last year. But on average, in 5 years, you will grow by 10%. That means that you will have earned $45,000 in equity, an increase in the value of your home over that 5-year time frame. That is 100% return on the 45,000 that you put in, which is on average a 20% return on investment. The smaller your down payments, the greater your return on investment. This is one of my last tips, ladies and gentlemen. Putting a bigger down payment isn't always better as long as you can afford the monthly payment. And it's because of this concept called leverage. So if you did the same $450,000 purchase price, you're putting $15,750. The home is still growing by $45,000. So in this prior example, when you put 45,000 down, it grew by 45 grand. If you put 15,000 down, it still grew by 45 grand because it's the purchase price that is growing, not your down payment amount. You had a 285% return in 5 years, or 57% per year. Gang, the second step of my wealth accumulation plan is to build an emergency fund. You should keep 3 to 6 months of your bills in an emergency fund. Now, sometimes when you're purchasing a home, you have to sacrifice or delete that emergency fund in order to come up with the down payment you need. That's why step one is owning your primary residence. But as soon as you buy that primary residence, now you need to focus on rebuilding that emergency fund. The third step is to max out your 401k or your IRA. That is the best return on investment because you get, most cases, an automatic bump because your employer will match a portion of it, and it's tax free money. But remember, it's step three in the wealth accumulation plan. So if you're in a position where you're saying, hey, I cannot afford this monthly payment because of my take home pay, maybe we scale back your investment into your 401k because you're going to grow more return, more equity, more wealth through having a primary residence than you will through your 401k. I'm not saying sacrifice the 401k, but I'm saying if you scale it back or you reduce it to 1% instead of 6%, that 5% difference can make the difference in your ability to afford the monthly payment in today's environment. Then you refinance a few years down the road, we lower that monthly payment, and now you max out your 401k again. The final thing, if you've done all three of the first steps, is you start investing in stocks. I won't get too far into that, but it's a simplified process. It's a Warren Buffett method. I will be doing my wealth building workshop down the road. I think I have it already set for the last week in April, and I'll talk to you more about this. Gang, here's the most important thing I will tell you. Your financing matters more than ever, and who you use for financing matters because it is a highly, highly competitive market. Your reputation of the loan officer and your real estate agent matter. What we do pre-offer to get you approved ahead of time matters. The fact that when you're writing offers, I'm calling the listing agent and talking you up makes a huge difference. The fact that we are going to fully underwrite your credit, income, and assets, you need to be willing to remove contingencies. That's something you're going to talk to your realtor about, that I'm going to talk to you about, and we've got to focus on a quick closing. That is critical in order to achieve success in today's market, is to have the right people behind you to get this done. Guys, I really, really appreciate your time today. If you're watching this and you're a first-time home buyer, you're probably wondering, well, John, why are you going to show me about how to buy an investment property? Well, it happens to be the next in my series. So maybe you know a family member who's thinking about buying an investment property, or a realtor who has clients that want to buy investment properties. Next week, I am going to be focusing my Financial Friday on how to buy investment properties. I hope that you've gotten good value out of this. Please like my Facebook page, like this video, share this with everybody that you know, and I look forward to being your guide in helping you achieve the goal of homeownership. Thanks, everybody, and have a wonderful day. Bye-bye.